They're not just players in the game, they are the game. With a flick of their wrist, they can send stock soaring or crashing. Hedge funds, the titans of finance. But their power doesn't stem from algorithms or strategies. No, their true strength lies in something far more potent, their people. And the most remarkable part? You don't need a prestigious Ivy League education or a high finance pedigree to join their ranks. A new breed of high earners has emerged at hedge funds that traditional finance bros are completely unaware of. These are individuals who command salaries in the hundreds of thousands, even millions, without ever stepping foot in a traditional corner office. They are the ones who hold the keys to the hedge fund kingdom, and today, we'll share their secrets with you. In the high-stakes world of hedge funds, a new force has emerged, reshaping the landscape. Those are multi-manager hedge funds.
We refer to ourselves as multi-manager platforms or multi-PM funds. Basically, multi-PM funds, like us, allocate capital across numerous portfolio managers who make autonomous investment decisions. This way, we are no longer reliant on a single decision maker.
Traditional firms produce goods through manufacturing processes involving input acquisition, production, and distribution. In contrast, hedge funds produce alpha, the excess return on investments relative to the market. And they do so by executing complex investment strategies. While the output of traditional firms is measured in units sold, hedge funds measure success by performance metrics such as alpha. And generating alpha requires market analysis, strategy development, and risk management. So this is Millennium, one of the biggest hedge funds ever, 64 billion assets under management, 5,600 employees. 330 investment teams. So these are all small teams with the same goal: generate as much money as possible. Yeah, so there you have it. 4 primary investment strategies are RV, fundamental equity, equity arbitrage, fixed income, commodities, quantitative strategies. So basically Why have these multi-manager hedge funds become so dominant? The answer lies in their comparative advantages. They offer stronger risk-adjusted returns and lower correlations to the broader hedge fund universe.
From 2019 to mid-2023, assets under management surged from $170 billion to $370 billion in our industry, with headcount growing by 80% to 18,100. Our growth has outpaced the rest of the hedge fund industry. They only managed around 13% growth over the same period.
The secret to this success? Diverse trading teams. These teams bring varied perspectives and expertise, essential for strategy diversification, market coverage, risk management, and innovation. Diverse teams aren't just a nice to have, they're a must-have for making more money, the most important thing in the world. Now, the rise of these multi-manager hedge funds has also sparked a global race for talent. The demand for business development executives, or headhunters, has also skyrocketed, because these executives play a crucial role in scouting and evaluating investment management talent. So ultimately, they drive the exponential growth of firms like Citadel or Point72. These kind of headhunters are not your normal type of recruiters. They're a different breed.
It's extremely competitive. Candidates need to have a deep understanding of the industry, excellent networking skills, and a track record of successful talent acquisition. Skills in networking, negotiation, and a deep understanding of the financial markets are crucial. Experience in talent acquisition within finance, strategic thinking, and the ability to identify high-potential candidates are also highly valued. Tailoring your approach to each firm's specific needs and demonstrating a strategic mindset can help you stand out.
The job market for business development roles. within hedge funds is fiercely competitive. Sophistication in operations has reached new heights, so they resemble professional sports teams. Needless to say, the hunt for top talent is relentless, with past performance and potential being key evaluation factors.
The advantages include high compensation, dynamic work environments, and significant influence on the firm's growth. However, it's a high-pressure role with long hours and intense competition. The stakes are higher, and the margin for error is getting much smaller.
Internal business development teams allow senior staff to focus on managing investments while cutting external recruiting costs. This is, of course, crucial for maintaining competitiveness and profitability. However, even with all these talks of cost cutting, business development executives still take home some of the biggest paydays in finance. Performance is not measured in generated alpha, but in how many young and hungry finance bros have been delivered that can potentially generate alpha.
Competency is evaluated based on successful hires, the quality of talent acquired, and the impact of those hires on the firm's performance.
Starting positions often involve talent scouting and junior recruitment roles. With experience and success, one can move up to senior business development roles, managing larger teams and strategies. Exceptional performance can lead to executive positions with substantial influence over firm strategy and direction.
To be honest, my dream was always to work in the finance industry as an investment guy, PE or hedge fund. But what I'm doing right now seems so much more powerful. I'm supplying the one resource these massive institutions need the most: talent.
Now, external recruiting costs vary. Retained search firms typically charge a percentage of the candidate's first-year cash compensation, ranging from 25% to 33%. Contingency search firms operate on a no-placement, no-fee basis, with fees ranging from 20 to 30% of the candidate's first-year salary. Flat fee search firms, they charge a flat fee, which can range from several thousands to tens of thousands of dollars, depending obviously on the search size. However, challenges remain. Non-compete agreements and rising recruiting costs have been key issues. But the FTC ban on non-compete agreements is going to change the landscape forever. This could increase talent mobility, heightening competition for skilled professionals. Firms may need to adapt their talent management strategies to focus on protecting intellectual property through alternative means.
In my opinion, the FTC ban on non-compete agreements will increase talent mobility, foster innovation, and potentially create more dynamic and competitive environments. But firms will also face challenges in talent retention and risk of talent poaching. The ban will likely increase talent mobility and lead to greater competition and innovation. Firms may also face challenges protecting intellectual property. However, I think it also presents opportunities for acquiring talent that was previously off limits due to non-compete clauses.
The high-stakes world of hedge fund recruiting is always evolving. With increased competition and regulatory changes comes a talent war, which is forcing funds to pay more for better talent, obviously diluting talent and increasing cost.
The talent war can lead to inflated salaries and aggressive hiring practices, potentially destabilizing funds. However, it also pushes firms to innovate and improve their value propositions. Balancing these dynamics will be essential for growth.
Concepts such as the pass-through fee structures have always raised investor scrutiny. In 2023, 73% of multi-managers had a full or partial pass-through structure, up from 63% in 2022. This model, though, can be a bit of a double-edged sword. While slashing costs may help, it can also threaten returns if it compromises investment teams. Not to explain that quickly, a pass-through fee structure is where a hedge fund directly bills investors for certain expenses instead of including those expenses in a higher management fee. As a consequence, investors directly see the expenses they're incurring, which can potentially lower overall fees. So pass-through fees are neither good nor bad, but increasing pass-through fees are bad. And investors have for years tolerated increasing pass-through fee structures because the returns have been amazing. But the weak hedge fund performance obviously is going to test their patience a little bit. As a consequence, right now in this climate, investors pay much more attention to fee structures and increasing overheads.
Transparency and communication with investors are key. Business development teams need to focus on acquiring high-performing talent that can deliver strong returns, even during market downturns. Managing costs and demonstrating value through strategic hires will be crucial.
Despite these challenges, multi-manager funds continue to attract investors. The top 5% of hedge fund managers are set to take 80 to 90% of investor inflows in 2023 and 2024. The competition is centralizing, with larger funds outcompeting smaller firms in talent acquisition and performance.
There's intense competition and high stakes in the world of hedge fund headhunting and business development. At the same time, this chase for talent is only going to get worse and more intense in the future.
Be prepared for a very demanding but also rewarding career. Build a strong network, stay informed about industry trends, and develop a keen eye for talent. Persistence, strategic thinking, and adaptability are key to success in this field.
The world of hedge fund headhunting is always going to be evolving. There's increased competition, regulatory changes, an ongoing talent bubble, and only the most adaptable, the biggest silverbacks will ultimately thrive. But it's probably worth fighting the fight because this is the backbone behind tomorrow's hedge fund giants.